Hello, good morning, everyone. Good Monday morning on Christmas week. Of course, Frank Ray here with Barry Habib. Hi, Barry.
Hey, buddy. Christmas week already. Isn't it amazing or what?
It's crazy, man, but I'm looking forward to it. You're gonna have a nice quarantine safe Christmas, Barry?
Yeah, just some close family, but you can't help but be with some people, right?
Gonna sit, one person in that room, one person in that
I
room.
don't think we're doing that. I don't think
Take
we're
it
going
aside,
that far.
shoveling the prime rib from behind the mask. Not that far.
That would be take the mask, shovel the food in. That's a little hard to do for me.
Oh,
I really get in there.
Yeah, trying times.
Yeah.
Oh, great. Well, glad to have you on the show. Let's talk about when we started talking, you said they're lying about what they're buying. And I thought that's why I titled today's show, They're Lying About What They're Buying. And what does that mean, they're lying? Who's lying about what they're buying, Barry?
So, I don't know if we want to call them liars, but they're not off by that much, bro. They're only off by like $60 billion a month. But, a billion here, a billion there. Before you know it, you're talking real money, right? So, So they said in the statement, they're buying $40 billion a month. When you do the research, that's just not true. They're buying $100 billion a month. I don't know why they're doing this and why they're trying to jawbone it down, but let me just give you an example. In the most recent week, they net purchased $27 billion in mortgage bonds. The week before was $33 billion. So there's $60 billion in just 2 weeks.
2 weeks.
They claim they're buying $40 billion. They're not. And you see what's happening is they're just debasing the currency. So let me try and explain what we have here and just put it into context.
Please do.
From 2008 to 2010, 3 years, the Fed added to their balance sheet and they purchased digitally. So they created money by adding to their balance sheet digitally. Now they're not printing it, it's on their balance sheet. There is a difference. So it's not something that creates hyperinflation or anything like that. But they created $1.4 trillion during that period. Now that's a lot. However, while $1.4 trillion is an awful lot to create, in just the past 9 months, they've created more than double that in 9 months. What it took them 3 years to do, they've doubled it in 9 months at 2.9, almost $3 trillion that they've created digitally. So what's been going on is that this has been causing the dollar to be debased, to be worth less. And with Janet Yellen, who, look, I've said this before, I don't think she was a good Fed chair. So, she wasn't a good Fed chair. Let's make her Treasury Secretary, right? Hey, there you go. So not only will her autograph be on all the money, but she is now, unlike Steve Mnuchin, the current Treasury Secretary, will be a cheerleader for Jerome Powell to be doing everything. Look, Jerome Powell wants to have a nanny state and wants to buy everything he can with Fed money and digitally created. Why is the Fed buying bonds of McDonald's and Apple? You tell me, does Apple really need somebody in there to help poor little Apple out? Are they really struggling that much? They can't sell their bonds, and Fed shares got to come in there and purchase billions of dollars of bonds, including Apple and McDonald's. It doesn't make sense to me. Trippy. So Steve Mnuchin butted heads with them, but Janet Yellen's going to be like, you're not doing enough. You're not buying, you buy some more. So what is going on is that as soon as Janet Yellen was appointed Treasury Secretary, there's people a lot smarter than me that knew this and could see this happening. The currency was under a lot of pressure, and that caused gold, silver to rise and Bitcoin to rise. We had a long talk about Bitcoin. We could talk about that, but why are these assets rising? Because those assets are deemed to be finite. So there's only so much Bitcoin, there's only so much gold, there's only so much silver, is what's presumed to be the correct thought process.
Okay.
But when you create more money, the more of something that you create, the less it's worth. That's why the Wayne Gretzky hockey rookie card just sold for $1.3 million, because it's rare. So the more rare an item is that's of value, the greater that value goes up. So when you take currency, which certainly has value, but now you start to create much more of it, the value of that currency goes down. Now, we're not alone in this debasement of currency. Other nations around the globe are doing this, but we have now achieved a 2.5-year low in the dollar relative to a basket of other currencies. So we're winning the race to debase. We're devaluing our currency faster than others are. Now, to some extent, do you really want a very strong dollar? No, because that hurts your exports, but you don't want a super weak dollar either for two reasons. The first one's easy. So if the dollar is now cheaper, it's worth less, it takes more of them to buy foreign goods. So if I'm importing stuff from China, if I'm importing stuff from Japan, from Europe, it takes more of my dollars to import that stuff. So therefore, I'm importing inflation. We're in the mortgage business. We don't want inflation because inflation causes rates to rise a little bit. As a result, you've seen the 10-year treasury move up a little bit here. So these are all happening in concert, but this is the reasons why. It's because we seem to be importing inflation. Here's the other. So a little bit more of an explanation required here, but when you get it, it's really eye-opening. So just pay attention, everyone. What happens when you debase your currency is that if you're a foreigner, you have less incentive to make an investment there. So let's just say you live in Europe, and maybe you're in Germany, and you said, well, I'm in Germany, I'm getting on my 10-year Buyin, I'm getting negative 60 basis points, right? So it's more appealing perhaps to look at what the US has to offer. And the US maybe has plus 1%. Let's just even go further. Let's just say you invest in mortgage-backed securities, and I can get, let's just pick a number, 2.5 or 3%. If you're in a 2.5% mortgage bond coupon, instead of getting negative 60, now you're getting 2.5. So now I'm getting a 3% rate of return better by investing in the US. Sounds like a good idea. All I gotta do is wire money to the US and do it. But I take my euro, I have to exchange it into dollars to purchase it, right? So I make my purchase, and based upon the exchange rate, it's an equal trade. But now if the dollar gets weaker and weaker and weaker, let's just say I made 3% on my trade. So I invested $100,000. I got back 3% on it. So now I've got 103,000 US dollars. But if US dollars lost 10% versus my currency, now I've got somewhere around, 98,700, just some quick math in my head. Let's call it $99,000. So here I am. I invested 100,000. I think I'm getting a much better return, but because of the value in currency drop, I've lost 10%. So it was about $90,000 or $89,700 is what I get. Now that I'm kind of thinking properly. The coffee's kicking in.
Get the idea though. I get the idea.
So I put my money in the US. I made more money than I would have had here on paper. But when I take the money back home, because the currency has changed, I've lost a lot of money. So smart investors have been saying, let's slow down. And we're seeing less foreign investment. Look at the auction results. Foreigners are scaling back. And with the appointment of Janet Yellen, this is just happening because people know Janet Yellen is going to be a big cheerleader for this. The problem with that is if we don't have that foreign investment, we could see yields go up a little bit. This all at the same time the Fed's saying to the public, we're keeping rates at zero for the foreseeable future. It'll be a long time. Let's just remember the last time the Fed did this between 2009 and 2016, mortgage rates went up in the 4-month period by 1.8%, and in a different time, 1.75%. So 2 periods of time while the Fed was at zero, mortgage rates spiked up. Now, I think that mortgage rates will be good. I think mortgage rates will stay low. There's a lot of other factors out there, slow growth, technology weighing on inflation that will help to keep our rates down. But we've got to be educated and on guard because there will be spikes. And by the way, those things like Bitcoin and while it won't be a straight line, gold, silver, gold and silver, watch for gold break above 1900. That would be a big move higher from there. But these are things that are telling us that the smart money is suggesting those things go higher, the debasement of the dollar continues.
Interesting. So if you're on your Robinhood app and you want to start moving some money around, you might start considering those areas.
Well, Frank, the other thing is, as you mentioned, Robinhood, and it's something else. And look, I don't like to talk too much about the investment side. We've kind of tried to stay in our lane, but we had to talk about Bitcoin not too long ago when it was, like 8,000. I thought it would hit maybe something like 20,000. It seemed crazy, and here we are, 23,000. Wasn't that long ago?
No.
But when we take a look at things like Robinhood and what does this teach us? It teaches us that we just need to be a little bit more on guard. This stock market, by every metrics, and John Walden had something last week he's a dear friend of mine, with another mutual friend, Doug Cass, and they looked at all the valuations, and we are in the 100th percentile in almost every single metric, meaning it's an expensive market. Now, it can stay expensive, it can get more expensive, but at some point in time, as one of my mentors told me many years ago, Barry, someday somebody's going to pull a plug on this thing. It's going to surprise a lot of people. It's been said that the stock market will hurt the most people that it can and do the most damage at the worst time. And, this kind of fits the bill. And when you start to take a look at the old, Joe Kennedy story, when he forecasted the crash in 1929, because the shoe shine boy that was giving a shoe shine was in the market and telling me, he said, well, where's the new money going to come from? And then when you looked at the 2001 or the 2000 crash for the dot-com bubble, you had cab drivers, day trading and things like that. Yeah. And the 2008, very similar, things like Robinhood and all these inexperienced investors coming in. It seems like, as Mark Twain said, history may not repeat itself, but it tends to rhyme. There's a lot of rhyming going on. And I'm not saying that we're going to get a big drop in the stock market imminently, but I am personally on guard for, just being careful here, maybe looking at things like the VIX just for volatility as a safe haven, or just playing it a little bit defensive. And I might miss out personally on things, but I am a little concerned that there might be something that could see a sharp move lower. I don't know. I mean, look, I'm not good enough to tell you.
It's good. No, understand, but appreciate what your feelings are about all this stuff. I think about all of our viewers,
And I'll go on record as saying, as far as the stock market goes, I've been dead wrong before too. So I have no clue. All I'm saying is that my antenna is up. Let me just say it like that. That I'm just thinking that we might be in for a period. We've had slumps in the stock market, and it's gone up from there. I mean, look at the move this year; it's been crazy, but it's been quite a run.
What an interesting show today for a Monday on Christmas week, Barry. I really appreciate it. So we got kind of a short week, right? Do the markets close on Christmas Eve early?
Early on Christmas Eve, closed on Christmas Day. We're going to get inflation data by PC, and we're going to get existing home sales where the media is going to screw it up. Watch for the number in median home price going from 313,000, probably up a little bit. And then the media is going to say, oh, year over year up 16%, 17%. You can't keep up with the median home price. We did the last show was affordability wall. They're going to bang the drum on that again, team. So be on guard. Watch the last show we did, and you'll know how to combat it.
Hey, Barry, thanks so much for being here. Love all your insights. Guys, the best way to stay in tune with everything that's going on in the market for you and your consumers is to be a part of MBS Highway and, of course, take Barry's Certified Mortgage Advisor course. I'll put links to both of those down below. So you can.
Hey, all of you folks that are listening, just wishing you a wonderful holiday week, safe, healthy, just wishing nothing but the best for you. Have a great holiday.
All right. Same from us over here at the National Real Estate Post. Y'all are awesome. Barry, thanks so much. And we'll catch up with you next week.
You got it, brother.
Hey, you guys have a great one. Leave us your comments down below. Forward, share, and subscribe. And you can get our mobile app by doing this.
Download the National Real Estate Post mobile app today. Available on Apple Store and Google Play. Just search National Real Estate Post.